In a world where the stock market seems like a roller coaster, one man has consistently beaten the odds, amazing wealth through wisdom, patience, and a set of principles that have stood the test of time. Hello, investors and dreamers. Today we are diving into the minds of an investment legend, Warren Buffett. Buffett's journey from a paper boy to the chairman of Berkshire Hathaway is nothing short of extraordinary. But how did he do it? What makes Warren Buffett one of the wealthiest and the most respected investors in the world? In this video, we are unraveling the secrets behind Buffett's success. We'll explore 5 key takeaways from his investing journey that you can apply to your own investment strategy. So grab your notebook and let's embark on this journey together. And if you like this kind of videos, do hit that like button, subscribe to our channel, and ring the bell to stay updated on our latest content. Ready to unlock the wisdom of Warren Buffett? So let's dive in. So, the first point is to invest in what you know. Have you ever wondered why some investors like Warren Buffett seem to beat the market consistently? What if I told you the secret might be as simple as sticking to what you know? Warren Buffett advocates for investors to put their money into businesses they understand. This doesn't mean you need to be an expert in every details of a business, but you should have a good grasp on how that particular business operates, what drives the profits of the business, and what are the potential risks and challenges that the business might go through. This kind of approach reduces the risk of unpleasant surprises and increases your chances of making informed investment decisions. So, now let's look at some of the examples of invest in what you know from Buffett's portfolio. So, Buffett famously invested in companies like Coca Cola and Gillette. These are brands that not only he understands but also believes in their long term value. Because he knows that these companies have enduring products that consumers will continue to purchase regardless of the economic fluctuations. Now let's move on to the second core principle, which is value investing. Have you ever found a high quality item on sale and thought it was just too good to be true? Investing can offer similar opportunities. So let's dive into how Warren Buffett finds these on sale stocks and why such an important cornerstone to his success. Value investing is the strategy of selecting stocks that appear to be trading for less than their intrinsic or book value. Buffett looks for companies with strong fundamentals, like they must have good solid earnings, they must be giving out good dividend yields, and a future growth potential. And also, these should be stocks and companies that are overall undervalued by the market. This approach allows investors to buy stocks at a good discount or at a sale. His famous quote is, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." So his investments in Apple, Coca-Cola, and the Bank of America shows the use of this principle, that is value investing. Now let's move on to the third principle, that is importance of patience. Have you ever wondered how some investors manage to build massive wealth over time, seemingly without making constant trades or chasing the latest trends? You might be thinking that they might be having some secret formula. Let me tell you, the secret might be as simple and even more accessible than you think it is. Buffett credits a significant part of his success to his patient approach to the markets. His famous quote, which goes by that the stock market is a device to transfer money from the impatient to the patient. So you might be thinking, okay, all of that is fine, but how do I become a more patient investor? So let me help you by giving you 3 important points that can help you become a more patient investor. First is to have a plan and always think that it's a long term journey. Understand that market volatility is normal and it's just the part of the game. Finally, remember that time and compounding is always going to be on your side. Warren Buffett has Coca Cola and American Express as his investments, where he had shown immense patience to still hold these stocks, and which have given him significant reward for his patience. Let's move on to the fourth point, which is the importance of risk management. Imagine losing just billions because you didn't know something really important. Warren Buffett says that this is the biggest risk of all. Intrigued? Okay, let's move on. Common perceptions of investment risks includes market volatility, economic downturns, etc. These are the common perceptions of what people have regarding investments. While these factors do play an important role, but there is a much more deeper and an often overlooked risk. Buffett states risk comes from not knowing what you're doing, and this is one of the biggest risks. Investing without understanding is just basically like sailing in an uncharted water territory. Therefore, knowledge is your best compass that can help you sail through the journey of investing. Here are some famous real life investment blunders that people made. First being the dot com bubble of 2000s, where people just rushed and invested without understanding of what they were actually doing. Similarly, the subprime mortgage crisis of 2007 2008. It's not just about the numbers, but understanding the business behind them is also very important. Buffett's extensive research and commitment to understanding his investments have shielded him from all of these significant losses. This highlights the importance of being well informed and understanding what you are actually doing. Buffett shows us that the greatest shield against risk is knowledge. And that's why it's very important to ask yourself this question is how well do you really know your investments? So now let's move on to the next point, that is the magic of compound interest. Imagine turning a single penny into millions of dollars. Sounds like magic? Warren Buffett calls it the power of compound interest. Compound interest is not just earning interest on your initial investment, but also earning interest on your interest accumulated over time. It's just basically a snowball effect in the financial world. He states that it's very important to invest as early as possible. The earlier you start, the more time compound interest has to work its magic out. It's also very important to stay invested in fundamentally good companies and buy the dips to build bigger positions. So, just basic two formulas for the magic of compound interest, that is to invest as early as possible and to stay invested and then let compounding take care of the rest. So this brings us to the end of the video. If you have any feedback related to the video, please let us know in the comment section. And this is the Average Investor signing off. Please do like, share and subscribe.